Okay, good afternoon, everyone, and welcome to this week's Headline Roundup. We're back live this week. Dennis is in studio and ready to go.
All right, I think, if you can see me okay, I'll pop off here in a minute, but hope everybody had a terrific holiday and had some travel booked last week. So again, back live today. A lot going on in the economy and the financial markets. Unfortunately, the markets are going the way that we had forecast at the end of the year. I'll talk about that today. I'll be talking a bit about some updates on currencies with Alasdair Macleod. So that said, Mark, I think just to save some bandwidth, did my video just go off there?
Yeah, you're good.
Okay, so let me jump in. Today is June 13, and a few things to talk about. I want to share with you some parallels to 1929. Alasdair Macleod has commented on economic deterioration, and I've got a section here that says, I hate to say I told you so, but this is from Portfolio Watch. This will be in your inbox if you are a Portfolio Watch subscriber tonight at 5 o'clock. And I wanted to share some parallels between 1929 and the Great Depression, and I wanted to talk about where we are presently, and there are some parallels. And again, I'll share these with you, and as I go through this, if you have a question, please go ahead and type it in the question area on the right-hand side of your screen. Mark is going to help me watch for those questions or comments, so we make sure we cover those for you. So let's start with the most notable similarity. If you look at the 1930s and the early part of the decade, and you look at where we are presently, we have almost identical debt levels in the private sector. So private sector just means non-governmental debt. Private sector debt in 1929, when you measured it as a percentage of the economy, was about 240%. So what that means is there were $2.40 in private sector debt for every $1 of economic output. And today, and this link is in the Portfolio Watch newsletter if you want to check it out for yourself, private sector debt levels are at the same approximate levels when you compare them to economic output. Now, there are some differences between economic conditions at the onset of the Great Depression and the present time as well. Now, there's two glaring variances that I point out in the Portfolio Watch this week. One is the currency system that's in use, and two, the levels of government debt that exist. And these two are very closely related. In 1929, the US dollar had a link to gold. Currency was linked to real money, and there was a limit to the amount of currency that could actually be created. Now that changed in 1933 when then President Franklin Roosevelt made it illegal for American citizens to own gold. But when the Depression began, the currency had a link to real money. Now, also in 1929, the US government wasn't broke, and that's certainly not true presently. In 1929, the total economic output of the United States was about $1 trillion, and I've got a source there that you can go check it out. Government debt at that time was about 170 billion. So that's a debt to GDP ratio of about 16%. Economic output about $1 trillion, debt about 170 billion. That is a pretty healthy government, all things considered. Now, just a side note, as the Depression progressed, you see that by 1933, on an annualized basis, economic output fell to $777 billion. Economic output fell by 27%. Now, fast forward to where we are today, and I've got a screenshot of the debt clock on the slide here. U.S. government debt now stands at more than $30 trillion. And you can see on the bottom right of this debt clock, that's 129.35% of the U.S. economy. So to summarize, private sector debt levels are about where they were when the Great Depression began. Now, I would argue the Great Depression was caused by debt excesses. But US government debt today is about 8 times greater than it was in 1929 when you measure debt as a percentage of the economy. So to use an analogy that many would be familiar with, in 1929, the government still had some room on its credit card to engage in deficit spending, which the government did throughout the decade of the 1930s and the 1940s with World War II. Now, today, I think it's safe to say that the government certainly doesn't have as much room left on its credit card, if it has any at all. And the question, of course, that comes to mind, anybody thinking about this stuff logically, the question that comes to mind is, how did US government debt get so out of hand? And this question kind of answers itself when you look at the second glaring difference between 1929 and the present, and that is the currency system that is in use now versus then. Keep in mind, in 1929, the US dollar still had a link to gold. There were still one ounce gold pieces that circulated as currency that were worth $20. Now today, the US dollar is a pure fiat currency, as is every other currency in use around the world. Now, if you are a new participant in these Headline Roundup webinars, the term fiat currency just means the currency has no tangible backing. It's currency by decree, it's currency by fiat. The reason the US dollar is legal tender for all debts, public and private, as it says on the back of the Federal Reserve note, is only because the government says it's legal tender. Now, fiat currencies can be created at the will and whim of politicians and central bankers. They can just literally create currency out of thin air, which has been happening via quantitative easing. Fiat currencies and the ability to create fiat currencies make it easy to fund huge deficits that could never be financed if honest money were used. And by using the term honest money, of course, I'm referring to precious metals. Now, it's this monster level of US government debt that will have to make the ultimate outcome that we experience a painful deflationary environment as well. The question is this: as deflation kicks in, and I'll share with you in a minute that Alasdair Macleod believes that it is. I have mentioned to you over the last couple of weeks that I believe we're seeing signs of this. The question becomes, as deflation kicks in, will the Federal Reserve, the nation's central bank, reverse course? Will they stop tightening, and will they begin another round of currency creation? And I have said many times and gone on record many times as saying that I believe they will. I don't think they have any choice. And when they do, that will, in my opinion, lead to more inflation, perhaps even hyperinflation, before the deflation sets in. Now, when you read the news, and I'll share with you in a minute that there's some banking executives now that are forecasting an economic hurricane, not just an economic storm, but an economic hurricane. There is a fundamental principle, economic principle, that has been completely left out of the prevailing narrative. Nobody's talking about it. Just because nobody's talking about this undeniable fundamental economic principle, ignoring it doesn't make it any less relevant. Not talking about it doesn't make it go away. Now, this principle is best described by a statement that was made by the late economist Herbert Stein, and I often quote Herbert Stein because he had some very simple yet some very profound wisdom when he said, if something cannot go on forever, it's going to stop. That is totally the case when it comes to deficit spending and debt accumulation funded by currency creation. You just simply can't keep creating currency out of thin air and use it to pay for tangible goods and services. I mean, you just have to apply a little common sense and a little critical thinking. And common sense, as the old saying goes, is not all that common anymore in my view. But this whole notion of creating currency out of thin air and trading it for things that have tangible value you have to conclude inescapably, as Portfolio Watch says here, that that cannot continue forever. It will have to end, and when it ends, history tells us it will be a deflationary environment, and it's my view the deflationary environment will be unlike any that anyone alive has ever seen. Now, the question is, and the question many of you probably have, is when does this occur? Well, not to be evasive, but the what is a lot easier to predict than the when. So the short answer to that question is nobody knows. Nobody knows the when, but we certainly know the what, because the what simply concludes that at some future point, we'll have to deal with all this accumulated debt. There is more debt that can ever possibly be paid. And when there's more debt than can be paid, we know it won't be paid. And then we'll have to deal with the debt at that point. And when you do, it will be ugly and unpleasant, and it will be deflationary. Now, when you look at the current rate of debt accumulation, and I want to go back and revisit something that I wrote about last week, I believe that when you look at the trajectory, and I'll share a chart with you here on the next slide, we're nearing this day of reckoning a lot faster than a lot of people think we may be. Now, the chart that I have here is from Gold, Switzerland. I often quote Matthew Piepenburg and Egon von Greyerz from Gold, Switzerland. And the chart that you see on the slide here points out that it took 2,000 years to get to the equivalent of $100 trillion of debt worldwide. 2,000 years to get to $100 trillion in debt worldwide. And then it took only another 21 years to triple that debt to 300 trillion. Now, at the present trajectory of debt accumulation, we're going to go from 300 trillion to 2 quadrillion in just 4 to 9 years. So it tripled in the last 21 years. In the next 4 to 9 years, it should go up 600 to 700%. Now, I cannot fathom getting to $2 quadrillion worldwide. I should say the equivalent of $2 quadrillion worldwide in debt before we see this deflationary period kick in and kick in hard. And that's why I often talk about the revenue sourcing planning strategy to position your assets. Now, this past week, I was walking through an antique store, and I thought I'd share this story because I found it interesting. And I found an issue of a Life magazine. And there was a whole display of old Life magazines that were sealed. So being curious, I started to look at them, and I found an issue from December of 1931. The Depression was raging at that time, and Life magazine was talking about the Depression. In fact, the whole issue, which is on my desk at my home office, so I can read the rest of it, really centered around what was going on in the economy. Now, the Life magazine sold for 15 cents, and on the front cover, the Christmas issue of December of 1931, which is 91 years ago this December, there was a drawing of a very sad Santa who was sitting on the back of a single skinny, overworked reindeer that had its ribs visible. And they both looked sad. Now, there were a lot of references to the Depression that was raging at the time. And there was a jokes page, and the one tongue-in-cheek comment was, the one man who came through the Depression without worrying was a member of a nudist cult who was on a diet. Another said, the experts say the bottom has been reached. Nevertheless, we think the bottom has been reached. It obviously hadn't been. And then there was a David Letterman style list way before Letterman of the top 10 benefits of the Depression. A San Francisco judge reported the number of divorces has fallen off markedly. U.S. officers of aviation were informed they will no longer be required to make 3 dress changes daily. Colonel Randolph, who is head of the Secret Six, reports that he can now get anyone in Chicago bumped off from between $200 and $300. Mrs. Frank Kravitz of New Haven reports a decided improvement in her business of renting wedding gowns. People weren't buying them, they were renting them. Judge Stewart of Kenosha, Wisconsin, announces he's going to reduce fines for intoxication for $3 in costs to $1 in costs in order to line up with a nationwide economy drive. So you could get caught being intoxicated in public, and the fine was only $1, down from $3. Eli Culbertson declares that 20 million people in America have taken to bridge playing in order to help forget financial worries. Judge Dunkel of Denver announces he'll reduce alimony rates during the present depression. The president of Colgate University finds a marked improvement in scholastic standing due to the students taking things more seriously. Carl Horman notified the Los Angeles court that he wanted to call off his divorce suit as his barber business was too dull to finance the action. The Crusaders report that the price of gin in Washington has dropped to $1 per quart. Thought you might find a glimpse back in time interesting. Now on to a past guest on my radio program, Alasdair Macleod, has to say. The headline of his article is titled "Protection from a Currency Collapse." This was published just last week, Friday. He said, while markets seem becalmed, financial conditions are rapidly deteriorating. Last week, Jamie Dimon of JP Morgan Chase, the CEO of JP Morgan Chase, gave the clearest of signals that bank credit is beginning to contract. Keep in mind that as bank credit contracts, the money supply also contracts. The contraction of the money supply is the textbook definition of deflation. Bank credit spends just like cash. So that's a really important statement. Russia has consolidated its ruble, which has now become the strongest currency by far, backed by gold. The Fed announced the previous week that its balance sheet is in negative equity, and there's mounting evidence that we have a nascent crack-up boom, an emerging crack-up boom. Russia now appears to be protecting the ruble from these developments in the West, while previously she was only attacking the dollar's hegemony. China has yet to formulate a defensive currency policy, but it is likely to back the renminbi with a commodity basket, at least for foreign trade. So here's Alasdair Macleod saying China is likely going to back their currency with tangible stuff as well. If it is taken up more widely by the members of the Shanghai Cooperation Organization and the BRICS countries, the development of a new commodity-based supercurrency in Central Asia could end the dollar's global dominance. Macleod points out these are major developments, and he said, finally, due to widespread interest in the topic, he examines the outlook for residential property values in the event of a collapse of Western fiat currencies, and I will tell you, the outlook is not good. Now, in the interest of time, I'm going to share just a bit with you, but Macleod points out, and certainly I've been following Alasdair's work and I've known him for many years, he has been warning for years the world faces a fiat currency collapse. He said the reasoning was, and still is, because that's where monetary and economic policies are taking us. As I pointed out, Herbert Stein said if nothing can go on, if something cannot go on forever, it will stop. And that's really what Macleod is saying here in a nutshell. He said the only questions arising are whether the authorities around the world would realize the dangers of their inflationary and socialistic policies and change course, which he says is extremely unlikely. I certainly agree with that. And in the absence, in what form the financial crisis would take. So if policies are not changed, what does this ultimately look like? Well, Macleod correctly points out that history tells us fiat currencies always fail, and when they do, they're replaced by gold and silver in some form. Macleod says now that fiat currencies have seen a rapid debasement and we've seen commodity prices go through the roof, interest rates should be considerably higher. Yet in the Eurozone and Japan, they're still suppressed in negative territory. The reluctance of the European Central Bank and the Bank of Japan to permit them to rise is palpable. We're still, even with just the threat of a slowdown in the issuance of extra credit by commercial banks, and again, credit spends just like cash, he said we're now facing a sharp downturn in economic and financial activities. Commercial banks in Europe and Japan are uncomfortably leveraged, and they're unlikely to survive the mixture of higher interest rates, contracting bank credit, and an economic downturn without being bailed out by their central banks. And keep in mind that when credit begins to contract, it's because typically there's too much debt to be paid. When debt goes unpaid, currency disappears from the financial system and we have deflation. And if the central banks elect to try to bail out these failing banks, they have to create currency out of thin air to do so. And it's a vicious cycle. The Fed, which Macleod says is in a far better position than the European Central Bank and the Bank of Japan, the Fed has admitted unrealized losses on its bond portfolio of $330 billion, which is enough to wipe out its balance sheet equity 6 times over. All these central banks are in very, very poor shape. So Macleod concludes, I think correctly, that without the injection of huge amounts of new capital, the major banks are broke. And like a hole in the head, all we need now to complete the misery is a contraction in bank credit. Now, he points out that Jamie Dimon, the boss of JP Morgan Chase, upgraded his summary of the financial scene from stormy, and 9 days later, he said, we're facing a financial hurricane. Now, you can find those remarks all over. That was widely reported, maybe not on mainstream media, but reported all over. So here we've got the head of the largest commercial bank in America saying that we're facing a financial hurricane. Less observed, Macleod points out, were his remarks about what JP Morgan Chase was going to do about it. Dimon went on to say the bank is preparing itself for a non-benign environment. I think a non-benign environment, stated another way, is a malignant environment, and the bank is preparing itself for bad outcomes. He said, we can be sure the Fed will have spoken to Mr. Dimon about this. Bruce Kasman, the chief economist at JP Morgan, was then tasked with rowing back, saying he only saw a slowdown. So they tried to walk back the statement. Macleod points out that when you monitor bank credit and you take a look at it and examine it, when bank credit begins to contract, it always causes a crisis, because you go from expanding as a result of currency creation to contracting. Now, Macleod said this time around, the crisis revolves more around financial assets than it has in the past. Because for the last 40 years, interest rates have been declining. I mean, if you go back and take a look at the Fed funds rate, over the last 40 years, interest rates have been going one way, down. That means bank credit has increasingly focused not on stimulating production of real things, but the creation of this financial bubble, to paraphrase. He said, now we're seeing this change. We're seeing commodities now creep back into the monetary system. This plays into the currency money cycle that I've talked about, that as fiat currencies fail, they start to get backed by tangible stuff. Now, commodities are getting back into the system indirectly due to the sanctions against Russia, which is the world's largest commodities exporter. If you take a look at financing for speculation, this is margin loan on securities. I brought this up just a few weeks ago on this broadcast. You see the margin loans are declining. Dollar bank deposits have increased 160% by 2008. But as Macleod points out, you're now seeing all this contract. He said, we're now moving rapidly towards a human desire to protect what we have. This is fear. He said, we're now becoming more fear motivated than we are greed motivated. And Macleod correctly says that we can be reasonably certain that with the reluctance of banks to maintain levels of credit, they're contracting, they're not loaning money, the move from fear to fear from greed, Macleod says, is likely going to be very swift. He said, is the stuff of an apocalypse. Now, I have long said that I believe once the numbers are in place, I believe that by the first quarter of this year, we are going to actually conclude that we have been in a recession. This is an article by Jeff Cox that talks about something similar. The case that a recession is looming over the United States got stronger Friday as blistering inflation and historic lows in consumer sentiment painted an increasingly dark economic picture. As if the consumer price index increase of 8.6% wasn't bad enough news, that release was followed later in the morning by the University of Michigan Index of Consumer Sentiment. That level came in at 50.2, and that number may not mean much to you, but it is the lowest we've ever seen in that survey, going all the way back to 1978. That's the lowest level in 44 years. It's lower than at the height of the COVID outbreak, and it's even lower than the last inflation peak back in 1981. This is a big development. Taken together, the data add up to an outlook that's not good for those hoping the U.S. could skirt its first recession since the pandemic downturn of 2020. Peter Bukvar of the Bleakley Advisory Group said, I wouldn't be surprised if it, referring to the recession, started in the third quarter of this year. He said, you can say that we're in the midst of it right now in the beginning phase. Only in retrospect will we know for sure. But again, I believe that we are there. And I believe that it will be reported ultimately once the revisions are done that we have been there for most of 2022. Consumer spending remains resilient, but as I pointed out, credit card balances have doubled this year, and personal savings rates are lower than at any time since 2008. Household net worth in the first quarter fell. That's the first decline in 2 years. Household debt went up 8.3%, which is the biggest gain since 2006. So if you're wondering how households are dealing with inflation, they're really not. They're tapping out their credit cards and they're borrowing. The Atlanta Fed says second quarter GDP growth will come in at 0.9%. The Atlanta Fed said first quarter we had a decline. I believe those will all be revised and actually be smaller numbers once they finally reach a conclusion. The labor market is also starting to show some weakness. Finally, this week, I want to finish with Ron Paul's take on inflation. I've interviewed Ron Paul on my program in the past. I appreciate personally Mr. Paul's, or Dr. Paul, I should say, his perspective. And again, if you have a question, type it in the question box. Mark, I'm not seeing any questions yet, so if I'm missing one, please interrupt me. Otherwise, if you have a question, I think I've got about 4 more slides here, so feel free to jump in. Mark, am I seeing a question now?
There is one, but refers to the deflation that I thought I'd hold to the end.
Okay, let me get through this then. Thank you. So Ron Paul has this to say. And one thing Ron Paul, I think, has been right about over the years, at least in my opinion, is the role of the Fed in creating an artificial economy. Paul says this: Joe Biden has unveiled a 3-part plan to fight inflation, or at least make people think he's fighting inflation. One part of the plan involves having government agencies fix the supply chain problems that have led to shortages of numerous products. Of course, any attempt by the government to solve the supply chain problems, which were caused by prior government interventions, such as shutting down the economy for well over a year, will not just fail to solve supply shortage, but it's also going to create new problems. I couldn't agree more. I think it will have to create new problems. Deficit reduction is another part of Biden's anti-inflation plan. However, Biden has not proposed cutting welfare or warfare spending, not cutting spending. Instead, the deficit reduction plan consists of tax increases. And the last and most important part of Biden's inflation plan, according to Paul, is recognizing the Federal Reserve has the primary responsibility to control inflation, and President Biden has pledged to respect the Fed's independence, unlike former President Trump, who Biden accused of demeaning the Fed by subjecting the central bank to mean tweets. Paul said it's hard to believe that someone who's been in D.C. as long as Joe Biden really thinks Donald Trump was the first president to try to influence the Fed's conduct of monetary policy. Since the Fed's creation, presidents have used public and private pressure to convince the Fed to tailor monetary policy to advance their, meaning the president's, policy and political goals. When it comes to demeaning the Fed, Trump has nothing on Lyndon Johnson, who, frustrated over the Fed's refusal to tailor monetary policy to finance the Great Society in the Vietnam War, threw the Fed chairman against a wall. By passing the buck on inflation, Biden no doubt hopes to deflect blame from himself and his party before midterm elections. Unlike Biden's previous inflation scapegoats, greedy corporations, and Vladimir Putin, the Fed is actually responsible for creating and controlling inflation, something that I have said all along. Powell, the chair of the Federal Reserve, according to Paul, remains committed, at least verbally, to more rate increases this year, interest rate increases. However, even if the Fed follows through on all its projected rate increases, rates will still be at historic lows. I've said in the past that the Fed is not doing nearly enough to effectively address inflation, and nothing has changed there in my view. There are those on the Fed board who want more and bigger rate increases, but others worry that going too far too fast and increasing rates will cause a recession. I say it's too late to avoid it. Many economic experts are now saying America should be prepared for an increase in unemployment. This trade-off between high prices and high unemployment illustrates the insanity of our monetary policy. Janet Yellen, who's the former Fed chair and now Treasury Secretary, and Powell publicly admitted they were wrong to dismiss inflation as transitory. The fact that the two most recent Fed chairs made such a huge blunder or purposely refused to admit what was clear to many people shows the folly of relying on a secretive central bank to manage monetary policy. Instead of respecting the Fed's independence, President Biden should work with Congress to audit and then end the Fed. And I believe that we will revert back to a commodity or gold-backed monetary system at some point somewhere in the world. I think we're beginning to see it now, and I think that will lead to that outcome. So, Mark, that's what I have to cover today. I'm going to go ahead and pause, and we'll go ahead and try to answer some questions.
All right. The first question comes from Jeff. He says, when this monstrous deflationary period hits, how do you think the precious metals will perform?
Well, Jeff, I think precious metals are fundamentally a hedge against inflation, although precious metals historically have performed well in periods of economic turmoil. Expect that before the deflationary period kicks in earnest, the Fed will reverse course. I think we will have what Ludwig von Mises called a crack-up boom, and Ron Paul referred to that in his piece. Excuse me, that was Alasdair Macleod that referred to that. So I believe that metals will likely perform well as long as we have a period of economic turmoil. So I think metals have lagged a bit here, but I expect that they will catch up. And I think we saw some good movement last week in metals, and I expect that as long as we have turmoil, as long as we have economic uncertainty, that I would want to own metals. Hope that answers your question.
Okay, and then Jeff's follow-up question then is, during normal, and he put normal in quotes, periods of deflation, cash is an excellent asset to hold because it increases in value, has high optionality. However, with so much debt worldwide, all currencies being fiat, and a monetary reset still ahead of us, would you still be holding cash when this deflationary period hits?
Yeah, Jeff, I mean, I think the revenue sourcing approach is you want to hold some assets that will perform well in a deflationary environment. Certainly, as you point out, cash is one of those. Certainly some highly rated corporate bonds or corporate bond-based maybe insurance strategies can make some sense to protect from deflation. On the inflation hedge side, then I think you want to be a little bit more nimble and own some precious metals. Although, as I said, precious metals can perform well as long as we're dealing with a period of economic turmoil. So hope that answers your question.
Okay, we do not have any more questions. So if you have a quick question, type it in quickly and we'll get it answered before we wrap up.
We will be back next week. Next week, believe it or not, already June 20, we'll be back live again. And Mark, if we don't have any further questions, everybody, thank you for participating. Thank you for getting the word out. Our audience keeps growing, and we're very appreciative for the nice things you're saying about our work here. So have a terrific week, and we'll connect again next Monday, noon Eastern.
All right, there are no more questions. So with that, we will wrap it up. One quick announcement is that we will also, starting next week, we'll be simulcasting the headline roundup on the Retirement Lifestyle Advocates Facebook page. So that'll be a live stream on the Facebook page starting next week as well. So anyone that has had any trouble connecting here, you'll be able to watch on the Facebook Live. So that's our news for the week. We'll see you back live next week, June 20. Have a great week.